Hey guys, welcome back. In this video, I'm gonna go over the best ETFs for passive income in 2024. All right, so without further ado, let's get into the video. All right, so as you guys know, this is gonna be a video about the best ETFs for passive income in 2024. And this is what we're gonna be covering. An introduction to passive income through ETFs, the top ETFs to consider for passive income in 2024, and how to actually research the best one for you. There's too many glitz and glamour videos out there that just talk about high yields and how much money that this ETF can make you, but they don't really tell you how to research one or how to actually choose the best one for you. This video, I'm going to show you exactly how to do that. And then at the very end, I'm going to give you some very important considerations. All right, so as you guys know, I'm not a financial planner, advisor. I'm just some dude on YouTube. Make sure you read this disclaimer. All right, so let's get into an introduction to passive income through ETFs. All right, so introduction to passive income through ETFs. What is passive income and why are ETFs such an ideal choice? All right, so real quick, if you don't know what passive income is basically you not trading your time for money. It is your money making money for you, all right? We go back to the whole rich dad, poor dad thing. The rich don't work for money, they have money work for you. All right, and that is passive income. You're getting income that you're not having to work for. You're completely hands off. You don't have to worry about it. It is not something you're managing every single day. You're not being asked for decisions, and you're certainly not having to cover the repairs and maintenance of your tenants, right? This is completely passive. All right, so why are ETFs an ideal choice? Simple. They're tax efficient. Other benefits like diversification, they pay you a dividend, every quarter or every month, depending on which one you buy. It's completely hands off. You're not doing anything with it. You literally buy it and you wait. And between buying it and waiting, you're consistently buying in between, right? You're putting a little bit of money here and there, maybe after every paycheck. But yeah, that's passive income. And this is why ETFs are so ideal, because it's for a passive type of investor. All right, this is why it's so powerful to invest in ETFs. You also don't have to, worry about picking the winners, and certainly you're not going to have to worry about the losers in the ETF, right? The ETF fund manager is going to kick out the losers and keep the winners, and it's all done for you, right? You don't have to do anything, right? Right. All right. Also, let's move on. All right, the benefits of investing in ETFs for passive income, I kind of already covered this. But you get diversification. You're going to get either quarterly or monthly payments. You're also not going to have to worry about picking the winners or kicking out the losers. It's all done for you, right? It's completely hands off. All right, moving on, the 5 ETFs to consider for passive income in 2024. If you guys have been following this channel for a while, then you already know I got a spreadsheet made ready for you guys. I'll put a link down below in the description for you so you can look at this yourself. But let's take a look at the best dividend ETFs for passive income. So I'm going to pull up the spreadsheet. All right, so I chose 5 different ones. We have Vanguard, we have Schwab, we have iShares, we have Spider or SPDR, and we have Invesco. And these are, these are 5 reputable fund managers out there. All right, I included a description of each different fund. So like Vanguard, they're going to provide a convenient way to track the performance of stocks with high dividend yield through their ETF VYM. We have an expense ratio of 0.06%, a yield of 2.93%, and it's currently holding 560 different companies in that ETF at this moment. And it pays out quarterly. All right, so that means every 3 months you're going to get a payment for investing in this ETF. And then here, of course, is more information on that ETF if you'd like to go take a look. It's their actual website. So I chose 5 tickers. We have Vanguard's high dividend yield ETF. We have Schwab's US dividend equity ETF, SCHD, and I covered this in a previous video. iShares Select Dividend ETF, DVY, Spider's S&P Dividend ETF, SDY, and Invesco Dividend Achievers ETF, PFM. Let's go back and talk about how to actually research the best one for you. You're going to want to choose one with an acceptable expense ratio. All right, that is first and foremost. That's the most obvious, right? We don't want to invest into ETFs with high expense ratios because those high expense ratios could be the difference of spending $10,000 over the ownership of that fund over the lifetime of that investment, or spending $100,000, right? So we typically want to go with a low cost expense ratio type of ETF, all right? So that's what we want to look for. We also want one with rising dividend yield, all right? You don't want to choose one with a history of either having a dividend yield for like 1 year and then they cut the dividend yield or they lower the dividend yield. Especially when you're trying to build passive income, you want predictable passive income. You may not be at retirement now, but in the future you will, and you're definitely going to want predictable income. If you're trying to build this wealth snowball or this dividend snowball, the dividend yield is really important because it's going to be the thing that's going to pay you out, right? And you don't want a dividend ETF that has a dividend cut or dividend suspensions or any of that kind of stuff. All right, there are companies out there that can suspend their dividend yield for individual stocks. I've never heard of an ETF doing that, but again, you never know. All right, so it's just something you want to keep in the bank. All right, we also want to choose an ETF with a lot of diversification. All right, typically in ETFs, they diversify. They might have 100 different companies in that ETF, or maybe 200, 300, 400. When you start getting under, probably 75, it's probably a little more concentrated. Not typically a bad thing, but again, it's just something you want to be aware of. All right, no two ETFs are always going to have probably the same exact companies at the same exact weightings, at the same exact allocations. All right, most ETFs, they might invest in the same companies, but they'll assign a different weighting to them. They'll probably put more, like one ETF will put more money in Microsoft versus this ETF, and this ETF will put more value on like Nvidia, whereas this ETF will probably say, no, we don't need that much Nvidia, right? So every ETF is different, and every strategy of those ETFs are typically different. All right, so again, we want diversification. We also want to consider the yield and the payment schedule. All right, most ETFs are going to pay out quarterly, which is, every 3 months. There are some ETFs out there that do pay monthly, but again, you have to be very careful with those ones because you could see your principal, the money you just invested, actually start to erode over time. So you want to be very careful with that. Yield, I'm comfortable with between about 3 and 5%. I've gone up as high in my individual holdings as far as 4 and 6%. It may not seem sexy like a 10% or a 15% yield, but again, when you're taking risk and consider those type of considerations, you want to be very careful. All right, you want to be very careful what you buy because this one could turn 8%, 10%. But in one single month, your ETF went down 20, 25%, right? Again, you got to be careful with that. So, we also want to look at that. What makes the most sense for you? Do you want monthly payments, so you can build that snowball quicker, or do you not mind quarterly payments? All right. So that's something we absolutely want to consider. And again, yield, you'll see it expressed as a percentage like I have here. So you'll have like 2.93%, right? So on a hypothetical, let's say $100,000, right? You're going to be paid $2,930 a year. Doesn't seem sexy, right? But when you start taking in compounding, capital gains, capital appreciation, then it starts to look a little more attractive. And I'll get into that in just a second. Same for here for SCHD, on a hypothetical $100,000, you'll be making $3,560 a year. Now that's money you did not have to work for, all right? That is money that's completely passive. And you might have multiple income streams at this point, right? Or you might just be building up SCHD. Okay, so let's get back into the presentation. All right, so we're gonna go to Seeking Alpha, and you can sign up for free here. You don't need to pay to use this tool. And I'm actually gonna show you an example because I have a premium account. But I'm going to show you with a free account exactly what we're going to be doing here. So how to actually choose the best one for you and how to actually research this one. All right, so let's pull up Seeking Alpha. Of course, you're going to log in, create a free account, all that hoo-ha. But down here on the left side, we have comparisons. This is the tool we're going to want to use, right? And we're going to go down here and create new comparisons. So we're going to use those 5 ETFs that I gave you earlier. We're going to use VYM, SEHD, DVY, Divi, PFM, and which one was the other one? SDY. All right, SDY. Whoops. All right, cool. All right, so we have our 5, and we're going to compare these. Now, we're going to get the information we actually need. There is only one small little drawback in this, and that is the range, the past performance. I think you can only go back 5 years. All right, so we have our comparison, right? We see that VYM, I hope you guys can see it. Let me do this right here. Boom. All right, so my screen, I know, is somewhere down here. All right, so let's make this a little bigger. All right, cool. So we have VYM established since 2006, 0.06% ratio, or 0.06% ratio, and it has $66 billion under assets under management, which means that a lot of investors have piled their cash into this ETF. All right, same thing with Schwab, established in 2011, so it reaches that threshold of at least a decade in operation, and similar expense ratio to VYM, and $56 billion assets under management. Then we have DVY or Divi, 2003, 0.38% expense ratio. Then we also have PFM, 2005, 0.53% expense ratio, and then SDY with 20 billion assets under management and a 0.35% expense ratio. All right, so out of all of these, I would say PFM is probably the weakest in all honesty, and if I was investing money, I would probably kick out PFM immediately, right? Just off one, assets under management is low, which means that not a lot of investors a lot of investors are putting their money in there, but compared relative to the other ones, this one's the smallest one, right? Its expense ratio is also pretty high. So I would probably put that one on the chopping block. So let's look a little more. So this is the 1-year performance, but we don't want just price return, right? We want total return. So we're going to look at the total return, and this is going to paint a different picture for us. We can see that SCHD is doing really well, Divi is doing really well, PFM's second place, and then SDY is last, right? VYM, the Vanguard fund, is actually performing the best. But again, this doesn't tell the whole story. So we need to kind of look further back and see what that looks like. So we're going to go 5-year. And you can see that the story kind of changes. SCHD is now number 1. VYM is in second place. And then DVY is in third. Oh, I'm sorry. So you have PFM coming in second place? Yeah, second place over VYM. SCHD still first. So you see, like, when you start zooming out, it starts painting a different picture. But you could also see that as far as like the volatility and like what happened. So this obviously is, the pandemic that occurred. You can see how they all performed and then which one has actually, kind of come out on top. It looks like SCHG's just been wrecking it. If we had access to the 10-year, it would also paint a different picture. If you want to sign up for Seeking Alpha Pro, be my guest. For this example, you actually don't need it. So, all right, so we see the past performance of all these funds compared. So let's go down a little bit. We don't really care about the ETF grades, not in this example. We don't care about the trading. We do care about the dividends. All right, so we see that the dividend yields between all the funds. But one thing you want to keep an eye on is the CAGR, right? Compounded annual growth rate, right? So the dividend growth rate over 5 years for VYM has been 5.81%. For SCHD has been an astonishing 12.88%, whereas Divi has been 6.35, PFM 6.40, and then SDY 6.64, right? But if we go down a little bit more, we see that consecutive years of growth, of dividend growth, okay? So VYM is obviously winning. because they've been in, probably business longer. But we also have SHD trailing right behind them, right? And then you have Divi for 3 years, PFM for 6, and then SDY for 1. This right here tells me that these 3 funds have actually underperformed and they don't meet my criteria, right? All 3 of these have higher expense ratios than SCHD and VYM. Not only that, their consecutive years of dividend growth are much lower than SCHD and VYM, right? Again, past performance is not indicative of future returns. You don't know what can happen, but you can at least, get some assumptions, right? So you can come to your own conclusion. So based on this information, I know VYM and SCHD are top contenders for my portfolio, so I could build passive income. And they all pay quarterly. All right, so that's awesome. Concentration and risk. All right, this is where you understand the holdings, right? How many holdings each ETF holds. And it's important to know this because you want to know how diversified these ETFs are. Are they concentrated or are they diversified? And we can see VYM has 560 holdings, SCHD has 103, Divi has 104, PFM has 427, and SDY 136. All right, so we know how many holdings each ETF has. So we have to kind of come to a decision. What is the best ETF for me in 2024 to build passive income? And honestly, it would be a split between VYM and SCHD. And if I'm a younger investor looking to build passive income for the long term, I would honestly probably go with SCHD. SCHD would be my pick. However, if I wanted to lower the risk and be a little on the safer side, I would go with VYM. All right, so those are my thoughts on these 2 ETFs. So let's get back into the presentation. If you guys like this type of content, just a quick plug for my community. I have a free community. I'll put a link down below in the description. It's a community of just investors. We're all learning together. We're all trying to build wealth together. I have a investing masterclass series, a full course built out in the classroom that you can access for free. Eventually, once we reach enough members, I want to start introducing Q&A calls, coaching calls, getting us on calls so we can all talk to each other and actually, kind of talk about our wealth building journey. People can ask questions, things like that. I'll put a link down below in the description for you. All right, so some important considerations before you buy anything, okay? If you're gonna buy something, you need to have a strategy. It needs to fit your strategy, first off. If you're gonna buy like SCHD, it needs to fit your strategy. Are you an income investor? Are you, trying to build, some type of passive income? What is your actual strategy? Whatever your strategy is, and whichever one you choose, you need to be a long-term investor. You need to think long-term, okay? You can't buy your SCHD today, go on Facebook, read some bad comments about it, and then go out and sell it the next day, right? There's always going to be, bears and bulls, right? For everything, for stocks and for ETFs. There's always going to be good and bad for everything, right? But you have to decide what makes the most sense for you, and you have to follow your strategy, and you have to be a long-term investor, all right? Long-term, that is when you'll see the best results, is when you're investing consistently over the long term. You want to regularly monitor it. I'm not talking about daily either. Maybe you check in on it maybe once a quarter, maybe once a year. SCHD, again, has a track record. It has a history of performance. So if I was to purchase this ETF, I probably wouldn't even check on it all that often. I would probably check on it maybe once a year, to be quite honest. ETFs, you really don't need to check on it unless you're getting into those very specialized ETFs, the thematic ETFs, for example. There's also, sector ETFs. Those are the ETFs you want to regularly monitor. But, for something like SCHD, that's a dividend income ETF, I probably wouldn't really check on it all that much. Last one, you want to reinvest your dividends for sure, right? You can't build a dividend snowball if you keep taking the dividends and spending it on other things. There's other strategies out there. A lot of people, what they'll do is they'll take the dividend and use the dividend to buy other companies. I am kind of split on that myself. I don't know if I like that strategy. I've done it a few times, but I think in the long term, you really should consider just reinvesting your dividends in the security that is coming from. So if you have SEHG and it produces a dividend, reinvest that dividend through a drip plan, dividend reinvestment plan, or if it goes into your money market account or your brokerage account, whatever, just take that money and reinvest it back into more shares of SCHD or whatever ETF you decide. All right. So that's it for me, guys. I hope you guys got a lot of value out of this video. I will see you guys in the next video. Peace.